following presentation is for educational purposes only. All of the symbols, trading ideas, and live trading are for demonstrational purposes and are not recommendations or trading advice. Past performance may not be indicative of future results. All of the information and opinions expressed by third-party guests are their own and are not necessarily those of NinjaTrader LLC. Trading futures involve substantial risk and may not be suitable for everyone, and trading futures can result in losses greater than the initial required margin. Traders should only trade futures with risk capital. Risk capital is money that you can afford to lose without jeopardizing your financial security or current lifestyle. You can find additional disclosure information on the NinjaTrader website.
Welcome back to NinjaTrader Live. I'll be your host, Tom Schneider, CMT with NinjaTrader. And on this segment, Traders Workshop, we like to feature NinjaTrader ecosystem partners. And today is no different. We are welcoming back Dean Rogers from Kase Company. How you doing, Dean?
Doing real well, Tom. How are you doing?
Doing great for a Monday. I feel refreshed and ready to go after the crazy kind of Thursday holiday, Friday, low volume. How about you?
Really good. Yeah, that Thursday holiday always kind of throws the curveball in there, because you got to come back to work on Friday and then you got a couple days to reboot again and get back at it. So no, but things are good. Things are good. Markets are interesting and keeping me on my toes as usual. And yeah, so it's good day.
Yeah, for sure. So, we've been talking about some of the ways, you look at the markets. I think you and Cynthia have developed some really interesting indicators. They're all available on the NinjaTrader ecosystem. But today I think we're going to focus on identifying, exits, right? So exits come in a couple of different flavors, and your indicators can help you identify those exits depending on what you're trying to do. So, just really eager to hear what you have to say about that.
Absolutely. No, it's kind of funny whenever a lot of us, well, let me put it this way. So Miss Kase, one of my favorite sayings of hers was always, trades are like relationships. They're easy to get into, but they're hard to get out of. And so, yeah, and it's true. It's one of those things where we spend so much time as traders, as analysts, as people, trying to decide, hey, is the market going to go up? Is it going to go down? Should I be buying or should I be getting out of my position? Or should I be shorting the market? Whatever it might be, right? So we put a lot of time and effort into getting into the market and trying to decide, what is the direction? Are we in a trend? All of these different kind of things. A lot of the things that we do in technical analysis are basically set up, as you're going through and looking at technical analysis. A lot of the things that we do are really set up around kind of, should we be getting into this market?
Right.
But not a lot really focuses on should we be getting out of this market, right?
Right.
And so that's something, an area that we really tried to spend a lot of time on, especially in the early days. In my early days of working with Ms. Kase, I started working with her in 2000. But at that time, we were doing a lot of stuff on divergence, momentum divergence studies. So, we have two different indicators in the Kase Statware package. One is called the Kase PO or Kase Peak Oscillator, which is this indicator down at the bottom of the screen here. The Kase Peak Oscillator is a first derivative momentum indicator. So it's looking at the rate of change of price over time. And then we have the derivative of the Kase Peak Oscillator. So basically the Kase Peak Oscillator less a moving average of itself. And that is the KCD. So kind of like the MACD is, a exponential moving average less the, average of the exponential moving average, right?
Right.
We basically have the same thing with the KCD. It's just the derivative of the Kase PO. So it's looking at acceleration of price over time. And what makes these indicators unique, I mean, we use the momentum indicators in our entry system as well to look at, is momentum rising? Is it falling? Whatever else, right? Just like we would use the RSI or stochastic or MACD, when we're looking at momentum of the market. We do that with the Kase P on the KCD. But we also use them as an exit tool to identify momentum divergence, overbought and oversold signals, those kind of traditional trading indicator signals. So what we try to do, or what we do, is we look at momentum or momentum signals in specific terms. So basically bullish and bearish divergences or overbought and oversold signals as an opportunity to take profit out of a trade or exit a trade rather than enter a trade in the opposite direction. So the studies that we've done over the years and updated over the years really show that momentum signals, i.e. divergence and overbought, oversold signals, are good at showing us when the market's going to turn in a statistically significant manner. So usually a large enough turn that we want to take profit out of that trade, but they're not real great at identifying. I mean, they are usually in tandem with major market turns, when we turn from a bull market to a bear market, but they're not always, the divergences don't always trigger those signals. And so what I mean by that is whenever you see a divergence, you're probably going to get a statistically significant turn, a big enough turn in the market that you want to take profit out of your trade if you're like day trading, right? Or even swing trading. However, it might not necessarily be the beginning of a new or a reversal.
Right. So let's talk about the two definitions, because divergence we're familiar with, but some new traders might not be. Your definition of divergence, I think, is pretty standard, but in terms of the case indicators, where would you see divergence as an example? And usually when we talk about divergence, we're talking about comparing price against your indicator.
Exactly. Yeah. So no, and that's a great question. So to define divergence, basically, like if we're looking, for instance, at the KCD indicator here, as prices are rising, you'll see this red trend line gets drawn. This red trend line is identifying a divergence, a bearish divergence for us. So as prices were rising, momentum, or the peaks in momentum from the KCD indicator, were falling. They were becoming less positive.
So Dean, let's do something really quick. Can we turn on the crosshairs?
Yeah.
Because I know we can see your cursor. I don't know if it's coming through on the broadcast. So if we turn on the local, right, exactly.
Yeah, so there we go. So thank you. So basically, as prices were rising, so we're getting higher highs in price, we're getting lower highs in momentum. And so what we've done is it's an easy concept, right? So as prices rise, momentum falls. So it's showing that as prices were getting higher and higher, the rate at which prices, in this case, the acceleration of prices rising, was declining, meaning that we're seeing a weakening of that directional trend.
It's kind of like throwing a ball up in the air, right? As the ball goes higher, eventually gravity pulls it down. And
exactly. That's always exactly. Yeah. So as the ball goes higher and higher and higher, you're eventually going to see it turn to the downside. So ball's going higher, the momentum of the ball is declining, due to gravitational forces and whatever else. And then the market turns down. Same thing, same kind of concept here. And then in the opposite direction, as prices are falling, if momentum, in this case on the KCD, is becoming less negative, so i.e. it's rising, right? Now it's not rising in the sense of momentum is not getting stronger. Momentum is just becoming less negative.
Correct.
Right? So in that situation, as prices were falling and momentum becomes less negative, we get a bullish divergence and then the market turns higher. And so that would be, these divergence signals for us are an opportunity to say, hey, something's changing with the market. This directional trend, if I'm in here and I'm short, or I'm in here and I'm long, I'm saying, hey, you know what? Something's changing. Something's happening where this trend or this directional move is becoming weaker. Let me go ahead and take some profit out of this trade, or let me get out of this trade.
Right. And the one thing we have to know about divergence is, in hindsight, it's easy to see. During divergence, you can see it.
Yeah.
But you have to have that confirmation that you have a lower peak high or a higher peak trough, right? Because
exactly,
if I see that, okay, well, this looks like a lower high, at the end of that divergence, it could have easily, price could have sustained and kept going and
Right.
made a higher peak high. So we have to have that confirmation on the second peak for some downturn.
Exactly. No, you played right into my next point
Oh boy.
perfectly.
Okay.
And that is, yeah, so you're on it. You're on it. You're reading my mind here. And that is, over the years, we've taken a lot of time to develop and perfect as much as possible a divergence algorithm to identify these signals automatically on the chart. And while it's a really easy concept, the algorithm behind it is, it's tricky. It's a tricky one. And so, what we do is we're looking basically, without getting into all the, bells and whistles on it, we're basically looking for two peaks in price. So we have an indicator called Kase swing that basically identifies swing highs and swing lows.
Sure.
And with that, we basically look for swing highs and swing lows. And so once we find two swing highs and two swing highs in this case, then we look and see, does this swing high match up with a swing high in momentum, which are these little red dots on the KSP or the KCD indicator. These are basically points at which we have a swing high or a high in momentum. So momentum is no longer rising, it's beginning to fall. So does this red dot match up with a swing high within at least 2 bars?
Okay.
And that's a variable. The 2 bars is a variable. 2 bars is what we have found to be optimal in most situations. And then when we get the second peak in price, does that match up within 1 or 2 bars of the price peak? So in this case, the momentum peak is exactly in line with the price peak, but we wouldn't know that. And this is always the tricky part whenever I'm showing clients these indicators and they're watching them in real time, they'll say, well, you're back drawing signals because this signal right now would not appear on the chart. We don't know that we have a swing high in price and a swing high in momentum that match within 1 bar or 2 bars of one another until this bar here closes.
Correct. Yeah.
Right. So there is a little bit of a lag there, but we want to see that confirmation because, as you made the point, if we don't see the confirmation and all of a sudden prices start to rise again and we start making new highs, well, that trend can extend and continue. And so we have to make sure that we see those confirmations before we take any kind of action. So in this case, we would have seen that divergence be confirmed on this bar here, where we have the orange S.
And Dean, kind of when you first run into divergence, when you first get exposed to it, it's compelling, right? It's a compelling concept.
Yeah.
And I think anybody who's looking into it, their natural next step is to, how do I quantify that, or how do I code it, right?
Right.
And it's very difficult.
Extreme.
Because there's no set rule as to how many bars between the peaks. You, like you said, you have the ability to modify how many bars that it happens within. You have to define that. Like, it's kind of a free-flowing thing. You know it when you see it, right? Yeah. But to code it, it's very difficult. So I think it's a cool thing that you've been able to do that.
Exactly. I mean, that's the thing is, like, with the indicators, where the divergence algorithm in specific, when we originally built it, it was something that we had where it was just with our KCD and KSPO. So it was very kind of like almost hard coded to the KSPO and the KCD, right? Sure. But over time, what I've done is we've developed an algorithm just in general that we can apply against the RSI, the MACD, the stochastic, whatever momentum indicator you want. And it can, identify divergences on those, because the rules for divergence on the MACD versus the RSI versus those, for momentum are the same as what we're using with the KCD and KSPO.
Sure.
It can get a little tricky. There's some little gray areas still that I'm trying to iron out on that. But, all of these, I brought this up because most of these variables for the KCD and the KSPO indicator are for the divergence algorithm. because we got to make sure that the peaks in price and the peaks of momentum are large enough, and all of these different kind of things. But the idea of what we want to do is when we identify those divergences, so we have red lines for divergences on the KCD, we have green lines on divergences for the case PO. As I was saying earlier, these don't always turn into opportunities to take a trade in the opposite direction. So when the prices were rising here, we might have been long from this area. We see this divergence as it's coming down. We take profit. We even have our stops. So we basically have our dev stops, which are the other way that we get out of the trades is our stop indicator. So we have the case dev stop indicator, which is standard deviations of the average true range over the last 30 bars. So we're using 1, 2.2, and 3.6 standard deviations. And so at that point, we saw the market turn down because of the divergence is triggering. We see that confirmation on this bar. We're also hitting Dev 1, which is this first blue dot. We have the warning line, Dev 1, Dev 2, and Dev 3, which are basically our stop levels. So as we're in this trade, we place a stop at Dev 3 that trails. When we see this divergence, we would normally pull the stop into Dev 1, but Dev 1 is hit at the same time. So we're out of that trade.
Okay.
But when we see that divergence, like our rule, our default rule with K-Statware is whenever we see a divergence, we exit 80% of our trade. So if I'm trading 10 contracts, I'm out of 8 of those. The other 2 contracts, I'm tightening up my stop. That way, if the market does, let's say we get that divergence, but it doesn't hit Dev 1, it doesn't have that 1 standard deviation move, and it turns higher, and basically it was a false signal or a premature signal, we're still participating in 20% of our original trade. And then we can look to get back in on the other 80%.
And that sounds like, it's playing off the probabilities, right? So
that's exactly
if that
right.
divergence indicator indicates a reverse X% of the time, could be 80%, right? Just what I would guess. But
no, you're absolutely right. I mean, it's dependent upon, different markets, but everything averages out to be, when you see a divergence, you're usually between 75 and 80% of the time, you're going to see at least a 1 standard deviation move in price or in the average true range.
In that direction.
In that direction, exactly. Right. So, basically what I'm saying is when we see this divergence, 75 to 80% of the time, we're going to see it hit at least Dev 1, which is a 1 standard deviation move of the average true range over the last 30 bars. So it's telling us that it's a big enough probability that we should actually, or that we're going to see a statistically significant move, that we should actually get out of this trade at this point.
Okay.
And so, or at least take some profit out of this trade. Right.
So Dean, I'm curious, and expecting the answer yes, because I know how technical analysis works, but have you tested this on intraday charts?
Oh yeah. Yes.
Yeah.
Yes, absolutely. Yes. Yeah. So we've tested it across all different types of bar lengths, all different types of bars. The majority of testing that we've done has been on daily charts because it's the easiest to gather data for and for the longest period of time, right? Because you get the most varying market conditions. But we've definitely tested it on intraday charts. Anywhere from, I think the lowest we probably went was 5 minutes. I don't think we did like a 1 minute chart or anything like that. But we've also tested like with our case bars, with range bars basically. And realistically, I mean, in everything that we've done, I'd have to dig up the studies, but I just know off the top of my head, everything is basically relatively the same as far as the performance.
Curious because, one thing about divergence is we have this probability expectation 75 to 80% time you'll see a 1 standard deviation move, in the opposite direction. But it doesn't mean that divergence is required, of course, for a reversal. We know that. I'm wondering if you've done the studies to say how many, what % of reversals are preceded by divergence. And I think that's interesting because, if I see a divergence and it's 40% of the time, then maybe I won't see, I don't expect maybe the next reversal to be preceded by divergence, if that makes sense. But have you done any of that kind of analysis?
We have. So we did an article, Cynthia wrote an article years ago that we did a study on called The Two Faces of Momentum. You can actually get on our website, caseco.com. We have an area with articles. You can download that article. It's called The Two Faces of Momentum. And in that article, we did exactly that. And so what we were trying to prove was, because when you do the study and you basically look at, how often there's a turn, and how often does it hit the different stops. So basically what we looked at was how often was there a divergence and what stop did it hit or close beyond. So
Okay.
Dev 1, Dev 2, Dev 3, we actually went all the way out to 6 standard deviations. And so what we were seeing was that, basically the KCPO and the KCD weren't necessarily outperforming traditional momentum indicators like the RSI, MACD, stochastic. They also, you see a divergence, but about 80% of the time, 75 to 80%, you're going to see at least a 1 standard deviation move, right? So we were kind of scratching our heads saying, okay, well, how do we prove that our indicators are better or more effective? And
Right.
that's exactly what we did. Was we started looking and saying, okay, well, every time we see let's say a 3 standard deviation move or a 1 standard deviation move, how often was it preceded by some sort of divergence signal? And so that's where we showed that our indicators were still showing that they were catching, when we saw basically like a 3 standard deviation move, which is what we're saying is statistically significant, we're usually in that situation around 75 to 80% of the time again, we're still seeing that being preceded by a divergence on the KCPO or the KCD. We aren't necessarily seeing that on the RSI, stochastic, and MACD. So that's where we separate ourselves a little bit from traditional momentum indicators with the case indicators, is we're catching about 80% of the turns. So whenever we see a turn that is statistically significant and hits Dev 3, we're usually going to catch that the majority of the time.
Okay.
Does that make sense?
It does. It does. It's about, in this case, it's probabilities, of course.
Right.
We do have the disclaimer, past performance not indicative
Of course.
of future results, but that's the whole point of analyzing historical data, is to see what has happened historically and statistically, what could we expect based on that history.
Exactly. I mean, we have to know, what are good signals, what are bad signals. And, again, I'm not saying that divergence is the perfect signal, but it is very good. It is a very good clue to tell us, hey, we might be seeing a turn. And one of my favorite things to do is look and say, hey, look, if we have a divergence on 2 different indicators or 3 different indicators, so if I see the KCPO and the KCD diverging at the same time, at the same point, and I have an overbought signal, so we also have which we haven't really talked about, but if we get an overbought signal, so like this little green P is telling me that the market was overbought at this point, and maybe even I have like a shooting star or some sort of candlestick pattern.
Right.
I'm looking for confirmation from other different sources, but these are all things that are telling me, hey, now is a time that I should take profit out of this trade. And that gets down to what we had originally talked about, was trades are like relationships, right? They're really easy to get into. They're hard to get out of. We never, as human beings, as traders, we don't want to be wrong. I don't want to be wrong.
Right.
When I'm making a trade, I believe in that trade. I'm looking at it and I'm saying, hey, you know what? I think this market's going to go up. I did a bunch of analysis. I did all kinds of research. I've read up on, maybe it's a stock, and I've read up on, all the, underlying fundamentals and whatever else. And, I've got all this information, and I go out and I make that trade and I buy it. And the next thing you know, it turns against me. And you're like, oh my gosh,
Right.
Or you get into that trade and it's going really well and you've made some good money. And you think, hey, you know what? I think it's going to, it's kind of like confirmation bias, right? I think it's going to continue going up. I'm going to stay in this thing. I'm going to ride this. In fact, you know what? I might buy some more.
Right.
I'm going to add to my position.
Well,
But
you
then
don't
we'll
you
see-
don't want the good thing to end, right? You're seeing this great trade and you don't want it to end.
Yeah, it's making you money and you don't want it to end, and it's doing great. But then you start to see signals like divergence, or you see some bearish candlesticks, whatever it might be, right? That's telling you it's hard to get at it. It's hard to unmarry yourself, from that trade that, conditions have changed over time. Things have changed, and that trade is no longer working out. and you need to get out of it. And so it's one of those things. It's hard to do because you spent a lot of time, and you kind of it's exciting. It made you a lot of money.
Right.
But that's the thing, is that's where these divergences, this sounds bad, but they're kind of like your friends tapping you on the shoulder saying, hey man, this isn't a good relationship for you here. This isn't healthy. They're basically telling you, hey, you probably need to get out of this trade, or at least take a step away, take some profit, give it a little bit of time, and then see if we should get back in, or just get the rest of the way out.
I'm not going to let my wife see this segment.
I was going to say, I'm feeling like it's a terrible analogy, but it's one of those things where, yeah, it's trading is difficult as it is, but getting out of trades, I mean, I've been there many times myself, where you're riding a high and you don't want to get out of that trade, but these signals like divergence, like overbought, oversold signal, and a trailing stop. I mean, a trailing stop is something we didn't get a lot of time to talk about, but that's really important to manage your risk.
Oh, for sure. We talk about trailing stops a lot. And we might pick that up again in the next time you're here.
Absolutely.
The
Absolutely.
concept is fairly simple, right? It's just executing the proper way. And ATRs are certainly a good way to go.
Yeah.
Dean, we're running up against time. So where can people find you?
So best place to find information about our indicators is our website, www.kaseco.com. So that's K as in Kelly, ASECO.com. You can find me on all social media at Kaseco. And then, just me, my email's pdeanrogers, or excuse me, I'm giving out my personal email address, dean@kaseco.com, DEAN at kaseco.com.
Awesome. Thanks, Dean. It's always great to talk to you and see you. And we'll do this again in a couple weeks. Say hi to Miss Kase for me.
I will.
And hope you have a great couple weeks, and we'll be back in a couple.
Yes, sir. Thank you, Tom.
All of the symbols, trading ideas, and live trading are for demonstrational purposes and are not recommendations or trading advice. Past performance may not be indicative of future results. All of the information and opinions expressed by third-party guests are their own and are not necessarily those of NinjaTrader LLC. Trading futures involve substantial risk and may not be suitable for everyone, and trading futures can result in losses greater than the initial required margin. Traders should only trade futures with risk capital. Risk capital is money that you can afford to lose without jeopardizing your financial security or current lifestyle. You can find additional disclosure information on the NinjaTrader website.